everybody, and welcome to this week's edition of Your Mortgage Process. I, of course, am your host, Greg Wareham. Before we get going with today's guest today, I just wanted to invite everybody, if you like what you've heard over the course of the past year, please like or subscribe to our YouTube channel and our different venues. We certainly appreciate your support and your time. So with that being said, I want to get into today's show, and today we're going to start to unravel the mystery of PMI. And I'm happy to say we have Mr. Steve Wacker today from Magic.
Hey, how you doing, Greg? Thanks for the invite. Excited to be here.
Yeah, pleasure to have you. Now, Steve, you run the state of New Jersey for Magic.
I do. MJC is a Milwaukee, Wisconsin-based company,
okay,
and I cover the state of New Jersey for them in the field sales, business development side.
Now, one thing that I know is anywhere that I've ever worked from a mortgage company standpoint, you're always my rep, and Magic's always one of the mortgage insurance companies.
You guys always try to lose me, but I'm always going to find you.
You're slippery. You always find your way back
always,
here.
Yeah, geographically, I cover the state, right. So, yeah.
Now, I want to just get into a little bit at how in the world did you end up in the mortgage insurance or PMI industry?
Yeah, it's a good question. It's going back ways at this point. Well, I think probably like a lot of us in the mortgage industry, you know, I didn't graduate from college and jump right into the industry as a whole. My education was in the sciences. And so the first 9.5 years of my, gainfully employed career, I was in the sciences.
Are you like a biologist or something?
Well, I'm close. I was a chemist.
Oh, right. Very interesting.
Yeah. So my postgraduate education is in the sciences. However, about 4 or 5 years into that, and I think some people who might be listening to this podcast today can relate. I had student loans that I had borrowed for because, I raised by a single parent. We couldn't afford, pay for that tuition at the time. And tuition today is just, crazy.
Outrageous.
So I became a licensed originator. I looked for something that gave me some flexibility, part-time, second job. And what I originated and made in income as a licensed originator while doing my full-time job as a chemist.
Right.
I took that and committed to paying off my student loans, which occurred for, over a 4 or 5 year period. I was able to pay it down to nothing.
And when did you make the switch over into PMI or working for Magic?
Yeah. So, 9.5 years into the sciences, I was kind of feeling like I wanted to get out more, see more things, do more things, not be put into an office space and do the office work.
Why not? That's so much fun.
I know. So
I love cubicles.
It's why I do what I do today, right? So I like changing environment and diversity, and so I was going to accept a job with, to be honest with you, Hewlett Packard Agilent Technologies at the time, doing sales up and down the East Coast. But I was kind of got cold feet at the last minute after actually leaving my position, and I was tired of it anyway. Only because I was living on the Gold Coast of what they call Gold Coast of New Jersey at the time, or now. Which
having fun, fast and loose. Let's go, baby.
Fast and loose, single, and I decided that wasn't really wanting to live out of a suitcase and in a Courtyard Marriott down the East Coast. So I said, well, what else do I know? And I just gave a loan officer full-time opportunity, on it. So from that point, I started originating loans, and here we are, 23 years later, full time. I'm still in the industry. I spent about 6 years originating loans.
Okay.
Very, loan originator, sales manager type environment. And then.
And that's important because it's important for you to understand the loan end of it and the consumer end of it, right? So you understand, what's important to the consumer, what's important to the loan officer with the PMI product and why it's so valuable.
Yeah, I think MJC puts a pretty large focus on understanding your customer.
Right.
And, I'm in a business-to-business position, sales position, right? I need to understand, Greg, what you do and what your challenges are. So having that background, many of us that work for MGIC have mortgage backgrounds or mortgage professionals in some way, shape, or form. It could be an underwriter, processor, it could be housing and finance agency people. We all have different backgrounds.
Sure.
But understanding the customer helps us understand your challenges.
Right, makes sense.
Yeah, and then, I just... One day, someone industry-wide came over to me and said, JC's got an opening. I know you mentioned a while back that you were, maybe you thought business to business might be a nice avenue to look at in the future. And
sure.
Next thing I know, I'm here 17 years.
And here we are.
Yeah.
Hey, so we were talking a little bit off air about PMI. And the perspective from the consumer at times is that PMI or private mortgage insurance is some sort of a penalty, right? I got to pay this additional amount of money because I'm putting down less than 20%. And although I understand where people are coming from, I don't think what people are understanding is without PMI, there's no way to buy a house without 20% down. And could you just talk a little bit about the history of PMI and how it comes to be?
Yeah, I mean, I'd be happy to do that, Greg. I mean,
thank you, Steve. I appreciate that.
You're welcome. I mean, hey, listen, that's one of the major misconceptions. You know, I do still speak to, you know, home buyers today. I speak to salespeople. You know, no one wants to pay mortgage insurance when they buy their home. They also don't want to pay interest on their loan and love to get the house for free, right? So, I mean, these are mechanisms or tools to get you into a home. You know, at the end of the day, mortgage insurance exists, and it's the history behind MGIC, to be honest with you. I mean, MGIC is the legacy company of the MI industry.
They're the first MI company?
They are.
First mainstream? Okay, really?
Founded in 1957 by an attorney out of Milwaukee whose name was Max Carl, who realized that, hey, all these savings and loans couldn't lend above 80 LTV or 20% down payment.
Right.
And the only other insurance out there was government insured.
Right.
And they wanted to introduce private capital and began MGIC as a PMI company.
So prior to that, the only option for the consumer to purchase a home with less than 20% down is really kind of VA or really FHA.
That's
really products. So you could not do a conventional mortgage without 20% down.
At that time, yes, correct.
Wow.
And obviously, it's very popular today to do that. So, you know, so from an investor side, people's misconception is it only benefits the lender.
Right.
And it is. It's a financial guarantee, a credit enhancement. And we could speak further about how that works. But at the end of the day, what I see is it's a mechanism, a tool for somebody, like you mentioned, to be able to get into a house sooner rather than later.
Sure.
Rather than try to save up for a 20% down payment. And, you know, if you kind of roll back the clock and said, if a PMI didn't exist, how would the market look? How would the real estate market look? You know, it would change drastically here.
I mean, candidly, we wouldn't be sitting here talking. Because it wouldn't be an industry that you would be in, and me from an origination standpoint over 25 years. I mean, there's a decent percentage of people that are putting down less than 20%, and they have PMI. So I want to dive into the PMI aspect of it, Steve. Okay. So what exactly does PMI insure?
When a PMI policy, and it's an insurance policy, is put in place, it ensures it's a financial guarantee for the lender or investor making the loan. And so maybe a good example here, to use very simplistic terms, is if someone was purchasing a home and was going to finance $100,000, right? Not really realistic in New Jersey, but realistic in other parts of the country.
Right. In 1957. Go ahead.
That's okay. But ease of explanation here, $100,000 loan. Let's say it was a 10% down loan, so it needed PMI.
Right.
So $110,000, $111,000 purchase price. Typically, the agencies or the end investor community requires a 25% coverage. And all that really means, Greg, is MGIC is insuring the top 25% of that loan.
Okay.
So the lender or investor making that loan, who's loaning out $100,000 to complete that transaction, it's his or her exposure, or the lender's exposure, is now $75,000.
Okay.
Because in the event of default or foreclosure, because the borrower wasn't able to make their payment for whatever reason that might be, MGIC gets a claim filed by that servicer, and ultimately we'll send them a check to make him partially whole or whole. I mean, and
it will insure them up to 25%, but it's so when someone files a claim, do they get the whole 25%, or is it something that's kind of back like a true insurance product, or you're trying to figure it out?
I'm simplifying it here, and of course, it's not the consumer who's getting the check; it's the end investor, because they're taking title to the property because the borrower defaulted on the loan. But there's attorney fees and interest accrual and some other factors involved in that. But at the end of the day, that lender feels comfortable lending at $75,000, where they would not have felt comfortable at $100,000 without mortgage insurance or PMI, and that's why they make the loan. But it also allows the borrower to get in with 10% down, because in that same scenario, that borrower may not have had another $10,000 to put into the home. Maybe that borrower would have taken 5, 6, 7 years to save up that money.
Right.
And in doing so, they lose 5, 10% appreciation, even 3 or 4%. You do the math.
Yeah, great point.
It's an equity builder, a wealth builder through equity.
Now, I'm going to break that down for our professionals out there listening. So there's different. You had brought up 25% PMI insurance required with 10% down. So if you put down 5%, it's 30%. And if you put down 15%, it's 12%. And just to be clear on that, so if I put 5% down, that means that we're insuring, in your $100,000 example, $30,000, right? So it's $70,000 the bank's on the hook for.
Correct.
Okay, that's great, and that's why the premiums are higher the lower the down payment that you make.
That's correct. Yeah.
Wow, this is all clarity. Nick, are you writing this stuff down? This is great.
I mean,
all right.
It's important, Greg, to understand that, historically, data suggests, and it's always, from all different resources. In fact, I just saw a report from the Urban Institute in January. The higher default rates on mortgages occur on the lower down payment loans.
Yeah, makes sense.
And so the less money down, less skin in the game, the higher default rate. So that is why the investor community requires PMI.
Right.
But I keep going back to saying that this is a vehicle for a home buyer to get in sooner rather than later, enjoy home ownership, and build wealth through equity. And that's clear as far as how much wealth you can build getting into your home in your 30s versus maybe waiting to your 40s or late 40s to do so.
Sure. You know what? I want to just talk about MI premiums in a second, PMI premiums, because there's such a difference. You've been in the industry 17 years. I've been in it for 25 years. And when 2008 hit, premiums skyrocketed, right? Because there was so much default for everybody. And I've seen since that time that the rates have went down pretty considerably. I mean, if you have really good credit and you're putting down 10%, it's not that expensive.
No, I mean, Greg, that's a great point. Today's mortgage insurance environment, different the way it's priced in premium relative to what it was back in the days you're mentioning the housing crisis.
Right.
Today's environment is what we would consider risk-based pricing.
Okay.
Right? Technology is able to get the MI industry there. So the higher risk markets are going to have a higher price. The lower, better performing risk markets are going to have the lower price. And that also applies to the consumer. Mm-hmm. Better credit, lower debt to income, the better variables on the loan. Those premiums are going to be lower cost for the consumer because the consumer is less risk in that transaction. But yes, the pricing on the housing crisis days was,
skyrocketed.
Sure.
But nowhere left. A lot of companies went out of business, right, Steve?
Sure. I mean, there were 6 MI companies at the time that housing crisis occurred, and only 3 survived.
Wow.
So, there's a lot to that from a capital position to understand that these insurance companies, we are an insurance company. I'm an insurance producer, although I'm a mortgage professional. I'm an insurance producer. My license in insurance.
Sure.
We have to have capital to make sure we survive those cyclical events.
Yeah, like any insurance product.
Absolutely. But yes, it is inexpensive for the better quality borrowers to get into homes, and it's really something that should be looked at, and people should, speak to their mortgage professionals on it. You
had just mentioned something a few minutes ago about the market that you're in, and that can impact your rate, right? So different pockets and different parts of a state or country could be higher risk categories than other marketplaces?
Yeah, I think, going back to the days where it was not risk-based pricing for the mortgage insurance industry and world, the price was more static, right, among the MI companies in general. And so, therefore, there wasn't a lot of variation. It was primarily how much did you put down and what was your credit.
Right.
But today's environment has changed. And so lots of factors. Basically anything that's put on a 1003 can be looked at from a risk-based perspective and priced into the mortgage insurance offering.
Yeah, that makes sense. It could be, it's regionally different, and credit obviously impacts your cost of PMI, as does your debt to income ratio impacts. What are some of the other things that impact it, Steve?
Yeah, debt to income and credit, down payment, which is coverage. Those are 3 major ones. But, if you're a first-time home buyer, or if you have a bankruptcy in the past, or, if there are multiple borrowers on an application, or maybe geography or concerns in certain markets. All those types of things. Like I said, anything that's really on that 1003 can be priced into a mortgage insurance offering. Sure. Now, I think in general, outside the major 2 or 3 categories, DTI, credit, down payment, and the rest of the stuff is kind of minor with regards to pricing differences, right, for the consumer. And I think, although risk-based pricing started 4 or 5 years ago as the industry as a whole, things have tightened up a bit where, all the MIs are pretty much looking at credit risk the same. Yeah. But, they're trying to price a loan on a price to perform basis. So, they're trying to produce a premium for every consumer that buys that type of scenario, or is in that type of loan scenario, and make sure that we're collecting premium enough to pay claims in the future. And that's how it works.
And and I just want to kind of reiterate that one more time. So PMI is an insurance product. And to the consumer out there, everyone else, this isn't a way that banks make more money, or they're not arbitrary numbers that you're being charged. It's no different than if you're getting insurance on anything. relative to your individual profile is going to dictate that cost of insurance. And when you look at something like credit's a really big risk factor when you're doing something like PMI, is tied directly to mortgage and your ability to repay. Just like if your credit's not strong, you're going to pay a higher rate on a credit card, you're going to pay a higher rate on a car. Like, it's just the way that it is. It's not an effort to make more money. It's to insure it and make sure you have the reserves for projected default rates that you have.
Yeah, I mean, it's a great point. I think a great example on actually how mortgage insurance went from a very static price based on just certain tranches or channels or price for credit and down payment was life insurance. Life insurance is actuary in nature. That's kind of what was brought into the mortgage insurance industry relative to loan performance. So more information, technology makes it easier, more granular. That's in my pricing today. So personally, I think it's never been any less expensive than it is now for borrowers with really good credit. Speaks to the people that do the right thing there. And then, of course, for those who aren't as good at credit, there are other alternatives to PMI, if that's what your mortgage originator is suggesting, whether it be FHA or VA. And those are also insured products, right? So you look at the industry as a whole, mortgage insurance is a widely used term. I represent MGIC, which is the private conventional agency, Fannie Mae, Freddie Mac loans, conventional loans, which require PMI. But you got FHA, and they got their own insurance premiums. Right. You got VA, and they have their insurance premiums. Yeah. So, all of it needs credit enhancement and protection so that you can make the loans with lower down payments.
Yeah, makes perfect sense, Steve. Now, here's a question that I get all the time. So, someone needs PMI, they're putting down 10%. How do I remove that? And I got my answer that I give to the consumer. But does the mortgage insurance company, do they have anything to do with the removal of PMI?
Yeah, so one of the most common questions I get, even from mortgage originators, some that are newer in the industry, because it's a bit convoluted of an answer, but I can simplify it.
Thank you. So, we like simple.
Yeah,
I'm a simple guy, Steve.
Right.
Keep
Let's
it
just
simple.
keep it straightforward, matter of fact, I think, bottom line is, here's the misconception that I get a lot. MGIC or any other MI company has nothing to do with the cancellation of mortgage insurance policies. So once the loan is closed, we'd like for you to put it on and use it because that's our product, that's our revenue. We have nothing to do with it after the fact. Cancellation, though, and that's one of the benefits of what I call this a great product that lets a borrower get into a home sooner rather than later, is that it's cancelable, right? At least with private mortgage insurance. It may not necessarily be the case with FHA today and some others. So just to clarify that.
Sure.
But yeah, I mean, we can go into how it's canceled. I usually look at it, Greg, as two different ways to simplify it. The first is, legislative in nature, and that's the Homeownership Protection Act. Yep. And that applies to one unit primary residence only. And it applies to all loans, regardless of who owns the asset, whoever services it, it doesn't matter. And what that is there's no seasoning requirement. Yeah. It addresses MI cancellation. Yep. Because there's no seasoning requirement, that loan has to be paid down to an 80 LTV off the original value of the
now Steve, does it have to be paid down to 80 or 78%?
Yeah, so good question. This is where things get confused. It can be paid down after closing to 80 at any time, and the borrower needs to initiate cancellation with their current servicer of record. Right. But at 78%, the borrower needs to do nothing. It will automatically terminate.
All right. So I'm going to reiterate that because and I get the question all the time as well. So first of all, after the Consumer Protection Finance Bureau, Dodd-Frank, all of that after the crash, there's no minimum amount of time that you have to keep PMI. Where years ago there was, but there's no minimum amount of time that you have to keep it. You can kill it once you have 20% equity in the property. You can remove it, but you have to reach out to the loan servicer to have that conversation. And then you can remove the PMI either through a reduction in principal, an increase in value, or a combination of both.
Yeah, so the important part, the Homeownership Protection Act, it does not address new appraised value. Okay. So it always works off the original value.
Interesting. Okay.
So the most recent transaction done, lower of the two, right? If it was a purchase or if it was a refinance. So original value. So if you start off as a 10% down loan, you need to pay it down from 90 to 80 off the original value. Now, it can be done, I look at scenarios like somebody who doesn't want a contingency on a purchase, They hold on to their primary residence, buy another residence, and then they plan to sell their property within 6 months, and they're going to gain equity out of that sale. Right. They could take those funds from that sale and pay down their loan to 80 and request MI cancellation.
That's a great point on it. So if you use the original purchase price, once you're at 20% equity, you can eliminate the PMI. However, if you're trying to use a combination of reduction in principal, increase in value, either independently or increase in value independently, or combination of reduction in principal and increase in value, is there a minimum time you have to hold that PMI?
Yeah. So what I just mentioned to you, as far as no seasoning and using original value and paying it down to 80 and actively pursuing removal or letting it get to 78 and have it automatically terminated, that's Homeownership Protection Act.
Yep.
However, there are investors and community banks and the agencies that are allow for a difference of removing MI being more flexible than that. Of course, that always applies to all loans.
Sure.
So the agencies have addressed new appraised value. So they recognize that, after a couple of years, you might have significant amount of equity in a home. So to your point here, if you're originator, if you're a consumer listening to this and your originator tells you have an agency loan or a Fannie Mae or a Freddie Mac owned loan, they say you can use a current appraised value, a 75 LTV with 2 years of seasoning.
Okay.
So 24 timely payments. It's important to know that.
Yep.
Because if you're not paying on time, you could probably dismiss the idea of canceling your MI.
Too late. You didn't pay on time.
Right.
Right.
And then, no second
liens. Which makes sense.
No second liens and no depreciating part of that property. So, in those situations, I would tell consumers, if I was the loan originator, hey, in 2 years, we can look at a refinance. But if that refinance doesn't make sense, you pay 24 timely payments. If you feel you have a 75 LTV, contact your servicer. They may charge you for an appraisal or an evaluation of some sort for your property. And if you have a 75 LTV, you can request cancellation of your mortgage insurance.
That's a great point. All right. So if you have a Fannie Mae, Freddie Mac loan, and you want to use an increase in value, appreciation in value, you have to be in it for 2 years to be able to use that value, and you need a 75% LTV.
That's correct.
Perfect. That's crystal clear.
Right? It's not so bad.
It's not that hard.
Right. I know that. Well,
But it's important for people to be able to articulate this upfront, especially a loan originator, to be able to articulate this to the prospective buyer, because it's important that people understand everything right out of the gates.
Yeah. One of the things that I do on a day-to-day basis, Greg, is exactly this conversation for originators to try to better understand and consult them on how to appropriately address that. MGIC offers lots of really great collateral that's both for the consumer and for the professional. So that addresses this. So I recognize it's not something that's top of mind for salespeople, but it's a top of mind question for the consumer.
Okay.
And that's PMI policies. So.
And then I'm going to move on to a couple other questions. I think this is just very important. So I just want to reiterate those 3 scenarios really quickly.
Sure.
So if you have PMI, your PMI is automatically removed once you have 78% loan to value or 22% equity in the property. If you want to use an increase in value to eliminate your PMI, you have to be in that home for 2 years to use that value, and you have to have 25% equity in the property. If you are just reducing the principal, I closed on a house last week. I want to put it towards my new mortgage that I just had taken out because I want to do it non-contingent. You can do that at any time. 80% loan to value, 20% equity in the property.
And request cancellation.
And request the cancellation. Yeah. Great. Thanks for clarifying all that, Steve.
You are
That's
welcome.
Great. So what are the different types of PMI? You can pay it monthly, right? You pay it up front. There's all sorts of different things you can do.
There are, Greg. We have... not to get into great detail on what we call premium product types and MI solutions, because that's what I try as an account manager at MJC to help people understand. When I say people, I mean loan officers.
Sure.
Better consult them on, here are the options you have when it comes to private mortgage insurance. Is it better for the borrower to pay it as a monthly, pay as you go, if you will, and then remove it through cancellation? Or maybe that borrower is sensitive to, or you got a debt to income issue, they're sensitive to housing expense, cash flow. Maybe they have extra funds. They want to pay all their mortgage insurance up front. Well, they can do that as well,
right?
And what we would call a single premium. And then there's blends in between of that where they pay partial upfront and partial on a monthly basis. So I would always, and then there's also another product where they call lender paid MI. Right. It might be disclosed as such to that. Understand from a consumer standpoint, the lender is paying on behalf of yourself.
Yeah.
The private mortgage insurance still being applied to that loan for saleability purposes.
Yeah, you bring up a great point with that. So all lender paid PMI is the lender is now paying the single premium PMI to the mortgage insurance company.
That's correct.
They're not self-insuring it.
No, self-insuring is something different. I mean, self-insuring truly is somebody who's making a loan, and it's not very common. And it's really mostly common with the small community banks of the world, where they're just doing a loan above 80 for other reasons, for business reasons, and taking more risk than they probably would like to, and doing a loan above 80. But, those are few and far between. The, secondary market is primarily, insured business.
So, Steve, what's generally the break even on that? And to clarify the question, so you can have monthly PMI, and then you have single premium PMI. Where is the break even where you would have made up that single premium at the monthly payment?
Well, it's a number you could always do.
Yeah.
Right. So you could just
do the math.
You could do the math.
Okay.
I mean, monthly premium is, divide, times it by 12, and that's your annual. And then how many annuals equals in addition when you add up 3 or 4, it's going to equal to the amount you're paying up front. So
there's no standard equation behind the scenes.
I mean, if I had to throw a, pin a tail on a donkey, if you will.
Take a swing at the pinata.
Yeah, it might be 4 years, 4.5 years.
You got young kids.
Yeah, exactly. Yeah. It might be 4 years, 5 years. I mean, part of that, Greg, it's an ever-changing and evolving number because, in our side of the MI industry, we have persistency. How long do policies stay in force? And so there's things involved in what we see from the general cancellation and runoff perspective. So that number kind of changes, but that's what the loan originator does, right? They'll present multiple options for, I hope to think they'll do this, multiple options for the consumer and say, here's your break-even standpoint. And if you stay in the house for 6 years and you take a monthly, you may have taken a little bit more out of your account to pay for MI if you couldn't cancel it.
Yeah.
But in those 6 years, you might come across 2 years of seasoning and a 75 LTV and had canceled it.
Right.
In which case, then you would have paid more up front than you needed to.
No question. That's where all the education needs to be done up front. I mean, you keep in mind with people that your average annual appreciation of a home since 2000 is about 4.4% in New Jersey. Since 1991, it's like 4.7%. So you kind of want to factor that in with deciding whether or not you're going to pay the single paid premium. The benefit of the single paid premium, and again, just to clarify, if you pay the lump sum up front and now PMI is not factored into your monthly payment, is it just gives you a reduction in payment as compared to carrying the PMI. In today's rising interest rate environment, it could be a potential option for somebody.
Yeah, I think, you've got some regulatory restraints behind that, from the points and fees. And for those who are professionals in the industry know that, that may limit you in those regards. But in this market, especially here in New Jersey, locally, it's really not as big an issue that it is maybe out in the Midwest with smaller loan amounts.
Because things are so expensive here.
Yeah, things are so expensive, so 3% goes a long way.
Right.
But to your point, I mean, I think it's really dependent upon what loan officers really do very well, right? I hope to think, and that is ask the appropriate questions for the consumer as to what their goals are over the next 3 to 5 to 7 years, and offer them the options that best fit their what they plan to do.
Couldn't agree with you more on that, Steve. So I've noticed there's about 6 different companies that you ever see in the PMI industry. It's kind of standard on the origination standpoint. And I've noticed over time that different companies, depending on the credit profile or the debt to income ratio, they have different pricing. And I've also noticed there's some sweet spots with it, right? Where some companies may be willing to take more risk at a lower premium. What drives all that in the industry from your perspective?
I mean, that goes back to our conversation earlier, right, Greg, that each MI company has a set of data. MJSC has a set of data dating back to 57 that we can look at and dissect regarding performance in every market condition we've ever seen.
Right.
And then we're going to try to price our premium to perform.
Yep.
But that's not a number that universally we're all going to have the same view on. So every MI company has a different version based on their data that they've had. Really, when I say data, their insurance in force, what they've experienced over the years they've been writing business.
Right.
So you're going to get in the risk-based pricing environment some variations to that. And once in a while, you might find a sweet spot where one MI company says, we're pricing this, and it looks more attractive. That's a great tool for the loan officer to, understand that, hey, this is a great deal for the consumer. But I would tell you though that generally speaking, it's insurance.
Yeah.
Right. So no one likes to be the lowest price in any sector of loans for any given period of time, especially for a long period of time. So, it's an evolving, ever-changing market that can change on a daily basis even.
Right. Yeah, no, that makes sense. And even when I compare it to interest rates in the mortgage industry, everything, I say a sweet spot, but it's such a marginal difference, right? It's everyone's kind of in the same ballpark on it for the most part.
I would say that's where we are today,
right?
Even with the risk-based pricing environment. But, when markets change, like we had with COVID, where forbearance is what we consider defaults, because forbearances are technically defaults, requires mortgage insurance companies to require more capital for writings or new policies. Pricing gets adjusted. Every MI company is going to think about how that's going to affect them differently. Therefore, it's built into the price.
Wow, I did not know that. So forbearance, they could still trigger the policy if someone goes into a forbearance where you have to pay. What did you do when forbearances became common during COVID? Was there like a waiver on that?
Well, we follow the agencies and do everything we can as their counterparty, major counterparty, to help them with that. But at the end of the day, a default is a default, and those are reported as default in many cases.
Right.
I think MJC's executive team felt pretty comfortable that even though they're being reported as defaults and we're having to set aside capital, capital intensive industry we're in, I think we felt pretty good that it would work itself out.
Sure.
Job stability, things of that nature that the market looked pretty good still if we got through the COVID issue.
Right.
So, we're obviously much better today than we were a couple of years ago with regards to our default inventory in that regard. But
and you got to be with a stable organization with mortgage insurance. Just thinking about it from a lender standpoint. Imagine we're in the midst of the crash. The market's falling apart. People are going into foreclosure. People aren't paying their mortgages back in 2008, 9, and 10. The mortgage insurance company goes out of business. Well, now you're on the hook.
Yeah,
right?
Well, I mentioned earlier that 3 out of the 6 MI companies didn't survive the housing crisis. At that time, and not to get into great detail, but the regulating agencies, or we are a regulated business, they used a ratio called risk to capital.
Right.
And that risk to capital gets up to a certain number, and your state regulator basically says you can no longer write business. And that's what happened to 3 of the 6. Now, MJC, a couple others, it didn't look so good there for, probably a few quarters if our executive team was on this podcast today. But, we survived. Today, it's handled a little bit differently. It's what they call PMIERs, which is just another way a different way of looking at capital requirements for all the MI providers.
Right.
To make sure that in another housing crisis like we had back in 08, 09, we'll be able to pay all our claims dollar for dollar, because some of those that didn't make it and survived that were paying 50 cents on the dollar through an IOU type environment. So to conceptualize it. So, it's real. It's why lenders are willing to make loans with 3%, as little as 3% down.
Right.
Because they want to know that MI provider is going to be there at times where people lose their jobs or can't pay.
Critical to the process, like behind the scenes, and this is what the consumer or even the agents or even a lot of times the loan officers do not see. This is critical behind the scenes.
Critical.
It's critical to make sure that you're going to have the solvency moving forward and you're partnering with the right company.
Yeah, that's why you look at MGIC and I think we're a leading mortgage insurance provider from a capital position above PMIERs, right?
Okay.
So we believe in that. We believe we're conservative in that regard. Monoline company.
Right.
This is what we do. And we've lived through this. We've lived through a few of these. Now, I have not lived through a few of these, but I lived through that one.
Right.
There was, at that time, restrictions for me to do business in New Jersey because we had to limit our ability to write new business. And in New Jersey, high-cost markets, that can be impacted.
Sure.
But we had to make sure we had enough capital to pay our claims and our responsibilities.
No question about it. So, Steve, I want to come back to the 3% down, which a lot of the times that's first-time home buyer, right? So are there certain programs for a first-time home buyer that allow the cost of PMI to be lower than if you were not a first-time home buyer?
Yeah, that's a great question as well. Obviously, there are first-time home buyer programs. The agencies, Fannie and Freddie, both have what I would call affordable lending programs.
Yeah.
And in
they got home ready, they got AMI programs.
Yeah. So to the consumer that's listening, to the loan officer, it carries a lower coverage mortgage insurance requirement. So less expensive to the consumer for the mortgage insurance piece of that loan, even at 3%. So ideally, it's a great product for people looking to finance through the agencies with a low down payment.
Yeah, I always wondered on that end of it, because on the lending side, what happens is if you're a first-time home buyer and you fit into the bucket, right? Income restrictions and all of that, there's a lot of the loan level price adjustments that are removed from Fannie Mae. So it gives someone a lower interest rate as a first-time home buyer. But in addition to that, you guys on the mortgage insurance end are also doing it at a reduced premium.
Well, we're doing it as a reduced premium because agencies allow us to do it at a reduced premium. We're really providing them what they're asking for. And, there is a big push here to provide diversified, affordable housing to everybody.
Yeah, all the rules are starting to circle around that.
Yeah, so for, from an equality standpoint, we're trying to get people in homes at the prices that real estate are at today. And it's difficult. So agencies look for different ways to do that, and lowering the MI coverage and taking more risk on their end is one way that they're doing it, and we oblige, of course.
Just to speak to that for 1 second, from a consumer standpoint, it's if you're a first-time home buyer right now and you qualify for first-time home buyer programs, and again, a lot of them are income restricted, so you really need to speak to, you can call me, you need to speak to your loan officer, you need to talk to somebody to understand what it is that you qualify for. But you can get a reduction in interest rate compounded with the reduction in private mortgage insurance, which can really reduce your payment in this environment. FHA also has made a recent change to reducing their cost of their mortgage insurance premium to make it more affordable for first-time home buyers. So from an administrative standpoint, there's a really strong push to get first-time home buyers into homes.
There are, Greg, and I'll reiterate what you said. I definitely suggest those who are listening or thinking about buying, call Greg Wareham.
I appreciate that, Steve.
Yeah, I mean, an educated originator is important in this environment. So some others who may not understand income restrictions and the loan level price adjustments that were mentioned, and the discounts and the advantages consumers might receive from certain affordable lending products.
Yeah, and this could be hundreds of dollars a month, which in this interest rate environment, it really makes a big difference from a purchasing power standpoint or just from a comfortability of payment standpoint.
It does. And then, as for the FHA, they've always played in that, 55 to 85 bit premium, monthly premium space.
Yeah.
They're lowering it for the same reasons that I think you're seeing these other affordable products being advertised and being made, and even some flexibility on income restrictions, right? So
yeah. So I have another question for you. It just popped into my mind. Down payment assistance programs. So if someone's getting a grant from the state, does that impact their pricing at all for mortgage insurance?
Yeah, no, the mortgage insurance providers, I can speak from the industry as a whole, we have no problems with down payment assistance, of course. There may be limitations on guidelines with borrower's own funds, depending on the scenarios that you're looking at. But it doesn't necessarily impact their pricing per se. A lot of those are grants with, some type of terms that may or may not need to be repaid.
Right.
But it's all part of the mortgage loan approval process. So speak to your loan originator and make sure that, it's something that can be used.
And I want to come back to one other thing that you had said about what the agencies are looking for. So your end of the business, a lot of that's controlled, for lack of a better way to put it, by what the agencies want and what they're requiring, correct?
Yeah, I mean, MGIC, the rest of the MIs are their largest counterparty risk provider. So, we try to support, what the agencies are trying to do on an any day given basis. And, without them, really, we'd have a hard time making ends meet, let's put it that way, relying on the portfolio lenders of the world to do just mortgage insurance. So, we try to do everything we can to align with what the agencies do, which makes it a lot easier on guys like you, Greg, right?
Yeah.
You can get a loan approved through Fannie Mae or Freddie Mac. You're highly likely to get it approved for mortgage insurance as well, parallel-wise.
I have to say, and I'm going to plug you, Steve, because if I have there's in some situations, you can have a transaction that even Fannie Mae will approve or desktop underwrite approve, but there may be a concern with PMI. You're a great person to call from a mortgage origination standpoint to understand what can and can't be done, and if there's any type of exception needed to be able to talk through the process. You really know your stuff.
Well, I appreciate that, Greg. I know we've had those conversations, and doing this as long as I have, I welcome those conversations up front, because you're trying to give some type of soft commitment to the consumer that's calling you, home buyer's calling you with regards to whether or not the loan's going to get approved, and you got mortgage insurance, another piece to the puzzle, if you will. And so, although we follow the agencies, there's some subjectivity to mortgage underwriting. We both know that.
Right.
I think it's important to know that the underwriters that sit at MGIC are mortgage underwriters.
Right.
I mean, they worked with lenders, they work with MGIC. I mean, we are mortgage professionals in general, and we want to make those loans as much as the loan originator does.
Yeah.
So I welcome phone calls as one of the many things that I do for those who lend in New Jersey, for sure.
Yeah, well, we're certainly going to give you Steve's contact information so you can stalk him in a couple of minutes here.
I appreciate that.
So when you look at risk-based pricing on mortgage insurance, does the type of property impact that? And I'll give you an example. So I should say occupancy. So a second home is priced differently than, say, an investment property with PMI? Because I know in some situations you put down 15% on an investment property, but I think the PMI, there's probably a lot of risk built into that.
Yeah, so the property type can be priced.
Yeah.
Again, it goes back to that. It's a check a box on the 1003.
Right.
So you got primary, you got second home, you got investment. Today, MGIC doesn't insure investment properties, but we have in the past.
Yep.
But it is insured with a couple of the other MI providers.
Mm-hmm.
I'd venture to guess, and probably put my paycheck on it, that it's higher priced on an investment property than it would be on a primary.
Significantly.
Significantly. And again, this goes back to risk, relative to the lender making the loan. Investment properties run a higher risk than they do for somebody who's living in a home and needs a place to live on a daily basis.
So thanks, Steve. Magic is the heritage company in the mortgage insurance space since 1957. What else makes you guys different? Like, I know you're great, Steve, and you know your stuff. What else do you think?
Well, you know what? It's a really good question, right? Because in today's environment, technology, the industry as a whole, right, Greg, and you feel this too as an originator, it becomes more and more commodity based, right? Customer calls up, what's your interest rate?
Yeah.
Same thing, right? A loan officer says, what's your premium price? But there's so much more to this industry as a whole.
Right.
I mean, for helping a consumer make maybe the biggest financial decision of their life when they take out a mortgage.
Right.
MGIC still holds to what they were so successful with over those years. And I call that value-added sales approach, where, I make sure I understand my customers, the lenders, the credit unions, the community banks. They all do business differently.
Mm-hmm.
And then I try to bring value and things that might help them. For instance, might be social media marketing assistance for one person. And it might be a lender who needs an outlet for an ARM product because they don't have one.
Right. Can
I match them up with some bank in Middle West that they can deliver to?
Right.
It might be staffing requirements. It might be industry insights. It might be, Hispanic marketing materials. And
sure.
we have, we as a company, we promote home ownership through using private mortgage insurance.
Right.
And so we have things that we do within our marketing group that address the consumer. So we have our website that's strictly for the consumer, written for the consumer in both English and Spanish, called readiness.com.
Mm-hmm.
But we also have another site that's for the mortgage professional called the Loan Officer Hub.
Right.
And educates them on podcasts like you have here today.
Sure.
We bring podcasts to them and all types of different value adds and different things that we do that, generally speaking, are at no cost.
Right.
And we just watch your mortgage insurance. I mean, that's really at the end of the day, that's what we're looking for. So,
but education's the key to all of that, right? I mean, you guys do a great job educating to the consumer, to the loan officer, to the real estate agent, to whomever.
Yeah. I mean, training has always been a marquee thing we've done,
right.
But we take it a step further in field sales. I mean, we'll join you on realtor presentations and discuss whatever it needs to be done. We have turnkey presentations for somebody who doesn't have a lot of resources in marketing, and that they can present our first-time homebuyer seminar just by giving me a call, and I provide them a PowerPoint deck that they can walk through and do it tomorrow.
Mm-hmm.
So there's lots of things we believe in partnerships still today. We don't believe this industry is commodity based, although we recognize that the price of our premium has to be competitive.
Sure.
In order to be who we are. And, I consider MJC continue today still to be the leader of the industry. So,
right. That's great. And if someone needed education, seminar, speak in front of either customer, mortgage company, real estate agents, what's the best way to reach out to you, Steve?
Cell phone.
Okay. Do you mind giving the number?
No, I don't mind at all. It's safe enough to do that. 609-713-2211.
Is there an email address or website that we want to give as well?
Yeah, I mean, my email is Steve, STEVE, _Wacker, WACKER, at MGIC, standing for Mortgage Guarantee Insurance Corporation.com. So Steve _Wacker at MGIC.com. Our main page website, for those who are interested, is MGIC.com. That's where you'll find our pricing calculator or pricing engine. And then, we do have those other sites for professionals and for consumers that if you call me, I'll share with you what those are. I think you'll find a lot of value in them.
That's great, Steve. I really appreciate you taking the time today. I know you're busy. I know you got a couple sick kids at home today, too.
My little one is not doing so good this morning. It's a little challenging, but I look forward to getting on this podcast today. I really appreciate it. It was exciting, and it was good. I love to talk about this stuff.
Great having you, Steve. Look forward to catching up with you soon. And for everyone out there, we appreciate you taking the time today to listen. We appreciate you paying attention to what we got going on. We appreciate you. Please hit like or subscribe if you like our show, and we'll look forward to catching up with you next week. Thanks, guys. Thank you for tuning in to this week's edition of Your Mortgage Process, hosted by Greg Wareham, produced by Greg Wareham and Nick Pavis at The Social Rift, and executively produced by The Social Rift. Thank you again for tuning in, and we look forward to catching up with you next week.